You see, when people think about American global power, they usually think about military strength, aircraft carriers patrolling international waters, hundreds of overseas bases, advanced weapon systems that outpace any competitor. But military power has always depended on something deeper, something less visible but more fundamental: finance. Behind every global power in history sits a financial system capable of sustaining it. The ability to raise funds, manage debt, and project economic influence across borders determines which nations rise and which decline. This video explains the financial backbone of American global power, how it formed over centuries, how it functions today, and why it remains so difficult to replace. No country becomes globally powerful by accident. Global influence requires deliberate construction over decades, sometimes centuries. Armies must be trained, equipped, and deployed. Alliances must be negotiated and maintained. Influence must be projected through aid, investment, and strategic engagement. All of this requires long-term funding, not just wealth, but the institutional capacity to mobilize resources when needed and sustain commitments over time. Throughout history, empires rose when they could finance expansion and declined when they could not. Rome's power depended on its ability to tax provinces and fund legions. Britain's empire was sustained by sophisticated credit markets and a central bank that could finance wars across continents. Spain, despite vast gold and silver from the Americas, collapsed under debt when it lacked the institutions to manage it. American power follows this same rule. Its dominance is not accidental. It is not solely the result of geography, resources, or military innovation. It is financial. The United States built a system that allows it to fund global commitments indefinitely, absorb economic shocks, and extend influence without direct territorial control. Understanding American power means understanding how that system works. From early in its history, the United States treated finance as a tool of national strength. This was not obvious. After independence, the country was weak, fragmented, and heavily indebted from the Revolutionary War. Alexander Hamilton, the first Treasury Secretary, recognized that the new nation would never survive without financial credibility. He pushed for the federal government to assume state debts, establish a national bank, and create a system of taxation and borrowing. This was controversial. Many saw federal debt as dangerous, a path to tyranny or collapse. But Hamilton understood something critical. A government that could borrow was a government that could act. Debt, if managed properly, was not weakness, it was capacity. This principle shaped American development. Federal taxation gave the government reliable revenue. Public borrowing allowed it to fund wars, infrastructure, and expansion without waiting for surpluses. Centralized institutions, particularly the Treasury and later the Federal Reserve, provided coordination and stability. Unlike older empires that relied heavily on tribute or direct extraction from colonies, the United States developed the ability to borrow at scale and repay over long periods. Investors, both domestic and foreign, trusted that the government would honor its obligations. This created flexibility, and flexibility is power. The ability to raise funds quickly in a crisis, to sustain spending over decades, to pivot resources toward new priorities without systemic collapse, this is what separates global powers from regional players. Major wars forced the United States to expand its financial capacity. Each conflict pushed the system further, creating institutions and practices that would outlast the wars themselves. The Civil War required the government to issue paper currency for the first time and dramatically expand borrowing. World War I turned the U.S. into a creditor nation, as European powers borrowed heavily to finance their war efforts. By the end of the war, the global financial center had shifted from London to New York. But it was World War II that fundamentally transformed American financial power. The war required unprecedented spending, over 35% of GDP at its peak. The government issued bonds on a massive scale, taxation increased, industrial production was reorganized. Rather than collapsing under this debt, the United States emerged stronger. The war had proven that the country could mobilize resources on a scale unmatched by any other nation. More importantly, the institutions created to manage wartime finance did not disappear after 1945. Debt became normalized, financial administration became permanent, agencies expanded, the Federal Reserve's role deepened, the Treasury developed sophisticated tools for managing borrowing and liquidity. This infrastructure allowed American power to extend far beyond its borders. The U.S. could fund the Marshall Plan to rebuild Europe. It could maintain military alliances and overseas bases. It could engage in long-term geopolitical competition without the immediate fiscal constraints that limited other nations. The lesson was clear. Sustained global power required sustained financial capacity, and the United States had built exactly that. The most important pillar of American financial power is not its economy alone. It is the dollar. After World War II, the international financial system was rebuilt around the US dollar. The Bretton Woods Agreement established the dollar as the anchor currency, with other nations pegging their currencies to it and the dollar itself backed by gold. When that system ended in 1971, the dollar did not lose its central role. Instead, it became even more embedded in global finance. No longer constrained by gold, the dollar's dominance shifted to something more structural: network effects. Global trade increasingly occurred in dollars. Oil, the most critical commodity, was priced in dollars. Central banks held dollars as reserves. International debt was issued in dollars. Financial contracts, from derivatives to bonds, used dollars as the standard. This meant that global commerce depended on American financial systems. Banks needed access to dollar clearing. Companies needed dollar liquidity. Governments needed dollar reserves to stabilize their currencies. Influence no longer required direct control. It operated through infrastructure. The U.S. did not need to occupy markets or dictate terms explicitly. The structure of global finance itself channeled activity through American institutions. This created forms of power that are difficult to measure but impossible to ignore. Sanctions became more effective because they could cut off access to dollar systems. Financial crises in other countries often required U.S. intervention or approval. Even adversaries held dollar reserves because alternatives were less liquid, less stable, or less trusted. The dollar's role is not guaranteed by law or force. It persists because the alternatives are worse. And that, more than anything, explains why it endures. American financial markets are not just places to invest, they are strategic assets. The depth and liquidity of U.S. capital markets give the country economic advantages that extend far beyond finance. Deep markets mean that the government can borrow enormous sums without disrupting prices. Liquid markets mean that capital can move quickly to where it is needed, funding innovation, responding to crises, or financing expansion. This creates a form of power that functions quietly and continuously. During the 2008 financial crisis, global investors fled to U.S. Treasury bonds, despite the fact that the crisis originated in the United States. The dollar strengthened even as American banks collapsed. Why? Because U.S. markets remained the safest, most liquid destination for capital. The same pattern repeated during the COVID-19 pandemic. As uncertainty spread, capital flowed into dollar assets. The Federal Reserve became the de facto lender of last resort not just for American institutions, but for central banks worldwide, providing dollar liquidity through swap lines. This is not simply economic strength, it is geopolitical leverage. Countries that depend on dollar liquidity must maintain access to U.S. financial systems. Companies that rely on American capital markets must comply with U.S. regulations. Investors who need stability gravitate toward dollar assets, reinforcing the system. Moreover, American markets attract global talent and innovation. Entrepreneurs, engineers, and financiers move to the United States not only for opportunity, but because the financial infrastructure supports risk-taking at scale. Venture capital, public equity markets, and corporate debt markets all function more efficiently than in most other countries. This creates a feedback loop. Innovation generates wealth, wealth deepens markets, deep markets attract more capital funds more innovation. The result is a system that sustains itself, generating influence without requiring constant intervention. American financial power persists because it is embedded in global systems. It is not imposed from above. It is woven into the structure of trade, finance, and institutions. Replacing the dollar would require more than political will. It would require rebuilding the entire architecture of global finance, new clearing systems, new reserve assets, new networks of trust and liquidity. This is not impossible, but it is extraordinarily difficult. Alternatives exist. The euro, the yuan, and digital currencies all have advocates, but each faces limitations. The euro is fragmented across multiple sovereigns. The yuan is controlled by a government that restricts capital flows. Digital currencies lack the stability and institutional backing that large-scale finance requires. More importantly, switching costs are high. Contracts written in dollars cannot be easily redenominated. Trade relationships built around dollar pricing require coordination to change. Reserve managers cannot dump dollars without destabilizing their own holdings. This does not mean the system is invulnerable. Overuse of sanctions, fiscal instability, or loss of institutional credibility could erode confidence. Other powers are building alternative systems, slowly and deliberately. But for now, the infrastructure remains. An infrastructure, once established, is difficult to replace. American global power is not sustained by force alone. It is sustained by a financial architecture built over centuries, refined through wars and crises, and embedded in the structure of the global economy. This system allows the United States to fund military alliances, absorb economic shocks, attract global capital, and project influence without direct territorial control. It operates continuously, often invisibly, shaping decisions made by governments, corporations, and investors worldwide. Understanding this system explains not just how power is maintained, but why it is so difficult to replace. Influence built into infrastructure does not require constant enforcement. It functions through incentives, dependencies, and the sheer difficulty of building alternatives. Military strength remains important, but the financial backbone beneath it is what makes sustained global power possible. And as long as that backbone remains intact, American influence